first market master for the day, Andrew Holland, the CEO of Ambit Investment Advisors, joins in to our discussion. Andrew, hi, good morning. Good to see you in. How are you dealing with this chaos in the Chinese markets? Do you think we will emerge unscathed, or do you think we will join that chaos?
We can't remain unscathed. I mean, this is the second largest economy in the world and the second largest stock market. How can you remain unscathed from that? You know, I was just thinking back that I remember, many years ago, in the US and Europe, they stopped short selling because there's obviously big problems in the banking sector, and then we worked out what that was later. Now, if you 40–50% of your stocks you can't trade, it's telling you something, right? So, the economy in my mind is there's some trouble there, and that's being played out, as we can see, in the commodity markets. So we can't remain unscathed. In fact, I just think we're all too complacent about what's happened in Greece and China. So, the shock when it comes is we're not going to like it, and markets are going to head lower from here, that's for sure. Our market is going down from here.
Okay, Andrew, that's a very useful analysis, because that's exactly what we want, a perspective. How bad do you think it can get? Do you think we see a huge tailspin in emerging markets, in fact, in all equity markets? And would there be a relative outperformance in India?
Relative is,
very relative.
You're still going to lose money if markets go down. So yeah, less pain. But, let's think about this. We're all rejoicing oil prices, which is good for India. I have no problem with that. But it's not good for Brazil. It's not good for Russia. And those problems will start emanating from there soon. So if then China comes in, then you've got Australia, you've got Brazil back, you've got Russia back. All the commodity kind of, exporting nations are going to have problems. So, this is not going away from us so quickly. And if I come to India and I think about the metal companies, I think the pain that they're going to take with lower prices. And then I can think about the stress in the banking sector. All these PSU banks are under stress anyway with these companies. So, it just takes another leg down for the banking sector, I'm afraid. So I can look at some of the individual stocks and say, yeah, they'll benefit from lower input prices. But the bigger picture is not as good.
So what are you doing now? Are you legging it out at all from some of the stock positions that you have? What are you doing in your alternate investment plan?
So, we're going to obviously, hedge a lot higher and try and work it through. But, between Greece and China the next 2 weeks is just going to lead to huge volatility. Whatever they're trying to do in China has obviously not been working. How do you go from hero to zero in a month? So it tells you something, and you can blame it on margin accounts and whatever. But the economy is telling you something. Markets always tell you that there's some problem somewhere, and that will emerge. And I don't think, ignoring the second largest economy in the world is madness.
No, fair point, Andrew. By the way, the markets are falling now. The Sensex is now down more than 200 points, down to the lowest point of trade, and the Bank Nifty is down more than 1%. So that's where the big brunt of the sell-off is actually coming in. Just keep an eye out on the screen. It's not looking very good in early morning trade. But, this is the worst we've seen China in a long time, Andrew. Do you think that there is a systemic risk that is threatening the financial stability of the economy that, that could take perhaps years to recover?
No, so I'm not saying it'll take years. I mean, maybe it'll force China to do more reforms. What you can expect is obviously more easing in China. And I've said before, one of my concerns has been, we're in a currency war globally. Now, if China's slowing, then who's exporting to China? And, China will obviously try and sell their way out of it by depreciating the currency. So we go through another leg of currency depreciation around the world, and that will bring commodity prices down even further. We'll then think about deflation, and then we'll think about slowing growth. So, whichever way I look at it, this is not a great scenario, and India, maybe in 2 to 3 months' time, when the dust settles, will look a better place. But right at the moment, it's not, and it can't withstand this kind of meltdown that we're seeing in China. Nowhere can. So I'm very concerned at the moment that these factors are going to pull us down quite sharply. We've been a bit too complacent. We've had a great run. But 8,500 anyway was the top of our trading range. So India standalone could not go above that. There's no catalyst to shove us a higher than 8,500. So I think we trade all the way back to first stop 8,200 in the very short term.
Yes, I think now the market is at its lowest point of the day. No, not yet. We had gone perhaps to 842 something, 8428 I think. We are still at 8438. So even after the recent dip, the early morning gap down has not gotten filled in. For technical traders, that could be important. The Bank Nifty as well was down 1.4, now 1.2. So, the early morning gap has not yet gotten filled in just yet. Keep your eye on all those stocks. At this point in time, there is a floor at that 8430 mark, but let's wait and see. Very, very, very early days, of course. I want to come back to the point you're making. Yes, competitive devaluation has been Governor Rajan's pet peeve as well. But is there a place to hide? Would you say that probably IT stocks or any of these drug stocks that don't export to Russia, how should an Indian investor respond? Just rank, get into cash?
I think sitting on the sidelines is absolutely the best place to be at the moment, and that's what we'll try and do. Just as we see the dust settle, I'm not going to try. I'm certainly not buying the bottom here of the market. We're near the top of the market as far as I'm concerned. So I'm not doing any kind of bottom fishing, because we're not even near the bottom of the market. Traditionally I would say, yeah, you can hide in the kind of IT sector, but I keep saying the decade of growth is over for these companies, and therefore, if anything, I'm just going to get more profit warnings going forward. In pharma, the regulatory environment in the US is so severe that, I just don't know who's going to get the drugs recalled or not, or the plants kind of revisited. So, I can't see I want to hide there. And consumer goods, again, I'm not paying 38 times to hide anywhere.
Okay. What do you do as a long-term investor in stocks that have an exposure to the Chinese market? Say, for example, Tata Motors, that derives a big chunk of its revenues from China. Do you, liquidate your positions there, or do you use every dip as a buying opportunity purely because some of these companies are best in breed?
So, here's the spin for Tata Motors, right? A few weeks ago, people were saying, well, everyone's buying the stock markets and they're not going to buy cars. Now they've lost so much in the stock market, probably they can't afford the cars. So whichever way I look at it, Tata Motors is going to suffer from this. And there's nothing locally, to give them a fillip. So I've never been a great buyer of Tata Motors, and I think it's even at these prices, it's probably a good short.
There are these notes coming in from several people trying to draw historical parallels to the fall in China. I heard that on CNBC in the morning, somebody comparing this to Japan in 1989-90, when the economy peaked, and thereafter we never saw the Japanese economy do what it did between 1950 to 1989, and the stock markets started tanking that year in 89, and even today have not reached the 89 highs. Is something like that happening in China? A long-drawn pain for the economy. Markets, of course, but there the FIs are less exposed. But is it that the economy is going to see such a long pain? In which case we are talking about a huge global meltdown in terms of real economy. I think we are... Okay, Andrew, you're able to hear me?
I can still hear you.
Yeah, I just wanted to know, are you looking at such a big global problem?
Okay. Yeah, no. So let me just say that I hope you're not right, because 2 decades of no growth for China would be pretty awful. But I don't think it's anywhere near that. I think the government will start easing in reforms, and obviously they've got a lot more monetary policy tools which they can use to on the currency side to ease the problems. So I don't see it as a Japan type style meltdown, which I mean the markets haven't peaked the way that Japan did in the 80s, so I don't see it like that. I think what we'll see is some pain which we're seeing in the commodities markets, and that's where we'll all be affected. I think my biggest worry, Latra, is this: is that even if you're a quarter right, and we do see markets kind of melting down globally, we have to question then whether the central banks around the world have been doing the right thing. And if we lose confidence there, that's where the big problem is going to be. I don't think it's just China melting down. It's whether we have the confidence that central banks around the world have the policy tools or have been doing the right things to bring the economies back into growth, which is still a question mark after 7 years of quantitative easing globally.
No, exactly. That argument went on to speak about the ability of central banks to pull economies out, and questioned that ability. But anyway, I mean, it's not my argument at all. It was some people drawing up disaster scenarios. Sorry, Sonia, you were saying something.
Well, no, I just wanted to get back to that point that Andrew was making about the top for this market, which could be 8,500. What about the downside, Andrew? I heard you fleetingly refer to the 8,200 mark, but if the combined impact of global risks and no local impetus hits our market hard, then what do you think the downside could be from now until the end of the year?
So I'm looking at the next few months, as I said before, as being hugely volatile, and anywhere towards 8,000 an index, I'm a buyer. That's for sure, because I still of the view, that our index will be nearer to 10,000 by the end of the year than it is today. So I'm not going away from those views. Obviously, I have to see how things play out in China. It's not very transparent, so you don't know what's going to hit you. But that would be my response today, is that 8,000 is where I'd be buying. I mean, you get pushed sometimes beyond that, as you do on the upside. Certainly on the downside, you get a little bit pushed beyond that. But 8,000 is where I'm going to start buying.
Okay, and what would you buy then?
Well, if I look at the positives, if I can, after being so negative, again, where commodity prices are today, and one big plus would be if the monsoons are okay, then 50 basis points rate cut has to come, so that would help the economy and leverage companies and the banking sector. Also, from what I'm picking up from companies I'm meeting, over the past 2 months, is that I think July, August, September, you'll start to see a pickup in earnings from across the board as the government spending leads to more contracts and orders and so forth. So I think when we come to the next reporting season, I think it's going to be a lot happier for companies. In terms of their outlook and the earnings recovery, and that's where we're going to get the market. So what would I buy if it gets to 8,000 or around that level? Then the banking sector, Reliance, Larsen & Toubro would be the key sectors and companies I'd be buying.
All right, Andrew, thank you very much for joining us.